Good morning. My name is Katrina Boyer. I'm the Investor Education Coordinator for the Pennsylvania Department of Banking and Securities. And it's my pleasure to bring to you this week's session of Midweek Money Matters, where we're going to be talking about the true cost of credit and some of the things that we can do in order to get the best rates possible. So before we get started into that, I want to just take a look really quickly. I want to make sure that we understand that the true cost of credit is not just that original amount, it's any interest and other fees and costs that are going to be associated with the loan. So if we look at a $10,000 loan that has an interest rate of 10% that will be paid off in 5 years, we're going to pay $2,746 in interest and potentially other costs. If we take that same loan and the interest rate goes from 10 to 25%, we're going to be looking at paying over $7,600 in fees and interest alone. That's a big difference. So one of the things that I want us to be able to focus on today is making sure that we are aware of different ways that we can go about getting the best interest rates possible and some of the things that we can do to cut back on costs. So we're going to talk about how interest rates are determined. Then we're going to sort of define what APR is because it's important that we understand what that is when we're applying for loans and making sure that we compare the same thing, the same type of loan to each individual, that we're considering. And then we're going to talk about we're going to give some tips on how to get your best opportunities when you're applying for loans. And then finally, because this is only a 30-minute session, each of our Midweek Money Matters always ends with a list of resources so that you can go to learn more. Because the reality is, I could talk for days about this topic and any of the other topics that we cover in our weekly events, but I only have 30 minutes. So I like to provide you with enough information that it leaves you hungry and eager to learn more by checking out the resources that we provide. So let's start at the beginning because your credit report and your score have a big impact on the loan terms that you're able to get. So making sure that your credit report is accurate is a really important first step. So we want to make sure that we do that. We also want to ensure that we go and check that report at www.annualcreditreport.com. At annualcreditreport.com, we are required by law to be able to pull that report once a year from each of the three credit reporting bureaus. Now, because we're in the middle of the pandemic, the credit reporting bureaus have made it so that you can check your credit report every week from each of the three credit reporting bureaus. So this is a really great time for people to be able to start checking their credit report and making sure that everything is accurate. Because we'll see in a few slides in a story about Jane who had some information on her credit report that wasn't right and the impact that it had on her ability to get a loan. So we also want to make sure that we point out when you pull your credit report from annual credit report, it's not going to include your score. But what your score is basically your score is your grade for what's on the report. So if we make sure that the report is accurate, then we know that the grade that we have or the score that we have is is what it is. So what we can do is work to improve our credit report so that the grade that we have on the report is stronger. So let's talk about credit score. As I said, the score is what it is based upon your report. So it's basically your report card. And the score goes anywhere from 300 all the way up to something like 850. So most of us fall somewhere in that good range between good and excellent. But understanding how that score is comprised is really important. So 35% of our grade or our score is the payment history that we have. So maintaining a strong payment history, paying our bills every single month on or before the due date is really important. That's 35% of our grade. 30% of our grade is the amounts that we actually owe. That takes into consideration all the different loans that we have, whether it's secured loan through a mortgage or a car loan, or whether it's a revolving credit, or it's some other type of loan. It's the amount that we owe altogether. One of the things that creditors look for is a percentage of use on credit cards of 30% or less. So if you have a $10,000 limit on your credit card, or the combined amount of your credit card, having less than $3,000 that you have outstanding on those cards is the key for us to get the best rate that we can. 10% of our credit report, our credit score, is the amount of new credit that we may have. So if we are applying for new credit, we need to take into consideration the fact that our new credit that we have is 10% of our score, our report, and it also can bring our score down if we have a lot of new credit or a lot of new credit applications. 15% of our score is the length or the amount of time that we've had credit. So making sure that we keep those credit cards that we've had for 25 or 30 years is really important, because that's the third biggest part of our credit. And then 10% is the mix of credit. It's a matter of having some revolving credit, like credit accounts, credit card accounts. It involves having mortgage, having personal loans, those types of things. It's the mix that we have, so we're not putting all of our credit into one specific kind. Um, so that comprises what our score is. But as I said, making sure that the report is accurate really does become what's most important as we are thinking about our credit score. So let's think about using a credit card to buy a new laptop computer. And that's not something that, that's a pretty common thing for individuals to put on a credit card. But what we need to stop to think about is the scenario where we put the card we put the computer on our credit card, and the interest rate is 18%, and we only make the minimum monthly payment. If we were to take that $800 laptop and pay $16 a month on it, it would take us more than 7 years to pay it off. To be exact, it would take us 94 months. And that's assuming that our interest rate doesn't change at all. And the reality is that sometimes interest rates go up based on how much of our available credit we're using and our payment history. Those types of things can cause our interest rates to go up. So it would take 7 years and 8 months to pay it off. And it would end up costing us an extra $689. So that $800 computer is going to cost us $1,489 and take us 7 years to pay it off. In the chat box, tell me, does anyone know how long it takes to pay off or how long a new laptop computer will last? Just an average. Tell me in the chat box. Because the reality is that a new laptop only lasts an average of absolutely 3 years. So we can count on a laptop to last us for 3 to 5 years. Thank you so much for those answers. But it's going to take us 7 years to pay, almost 8 years to pay it off. So by the time our laptop doesn't work anymore, we still have 2 years at least to pay it off. That doesn't make a whole lot of financial sense. So it's important that we use our credit in a way that is responsible. So we have to make sure that we're not making just the minimum payments. And we want to make sure that we are looking at our different options. So now I want to switch to um, a rate comparison for a 30-year mortgage interest. So if you're living in Pennsylvania and you finance $150,000 and you have a strong credit score, let's say your credit score is in that 750 range, you're going to be looking at an annual percentage rate, and we'll talk about exactly what that is, of almost 3%. Your payment's going to be $632 a month. If you have a lower credit score, let's say your credit score is in the 640 range, your payment is going to go up by 70 some dollars a month because your interest rate is almost, it's more than 3.25 or 3.75, it's 3.8. The interest that you're going to pay is $102,000 compared to $77,000 in that higher score range. So hopefully you can see where making sure before you step into a big loan, making sure that your credit is in the best place it can be is a really important thing to do. So let's just take a look at if our score was in that 680 range. If your score is in that 680 range, you're going to be paying, um, you're going to be paying, if your score is in the 680 range, if you bring that up by 20 points, you could save $5,000 over the life of your loan. If your score goes down, you could end up paying even higher. You could pay an extra $6,000 over the life of the loan. So hopefully this shows you what what a difference just a little bit of a change in score can do. So let's look then, let's talk about what the annual percentage rate is, because having that understanding, I think, is really important. So the annual percentage rate, or the APR, is the rate of interest that's charged to a borrower, you or I, on an annual basis. It's a percentage that takes into account the yearly costs of borrowing the money. It includes any fees, it includes application fees. If you have to pay, sometimes on a mortgage, you pay points. By paying points, you are lowering your interest rate, but it raises the annual percentage rate because the money that you pay to lower the stated rate gets calculated into the annual percentage rate. So it can be very confusing, but it's important to have the APR of whichever loans you're considering, because that APR is what you can use to compare different rates from different lenders. So being able to compare a loan that has all of the fees worked into it becomes really important. So earlier, I had talked about um, we talked about credit cards and how, so credit card APRs are based on the type of transaction that you open it with. So if you are opening a new credit card and transferring a balance from an old card onto a new card, because often credit cards will offer you so many months interest free, but they charge a percentage of what you're transferring. That gets calculated into your APR. Sometimes we take out a cash advance, but we have to do that. We have to pay a percentage of that to the credit card company. So that becomes part of our APR. And then any annual fees. There are credit card companies out there that charge somewhere between $25 and $75 or whatever fee they're going to charge you. That annual fee for that credit card is also calculated into the APR. So if you're considering opening a new account, make sure that you compare the fees that are associated with transferring that money, taking those cash advances, and any annual fees. There are credit cards out there that offer credit cards at no annual fee. If you are looking at different types of credit cards, make sure that you're looking at the right things. And the same goes for car loans. The annual percentage rate typically includes any application or origination fees. It may also include, sometimes when we buy a new car, we get gap insurance. So any other fees that we're required to pay with that application or with that loan gets calculated into that annual percentage rate. With a home mortgage, that typically includes origination, application fees. If you decide to pay for a discount in the interest, that the discount amount that you're paying is also calculated into that annual percentage rate. So it's important to understand what things are included when you are applying for new credit. Make sure that you understand what comprises that annual percentage rate. So let's talk about Jane. Jane is trying to buy a new car for $20,000. And the APR that she has been quoted is a 14.719%, which will make her payment $473 a month. Over the course of 5 years, she will pay $28,371. So she's paying $8,371 in interest and fees. So that will include her application fee and some of those things. But the reality is that's a lot of money. And Jane can't afford to pay $473 a month for a car. So she decided before buying the new car to go ahead and take a look at her credit report. And when she pulled her credit, she found that there were mistakes and she fixed them. Jane also worked on paying down her credit card debt. So she got it from where she was using 75% of her available credit. She got it down below that 30%. She got it down to something like 20%. And for the next 12 months, she made all of her payments on time before their due dates, and she paid extra when she could. Over the course of 12 months, that brought her credit score from 588 to 708. So that's an increase of 120 points. Okay, so that was a pretty big increase. At the end of the year, at the end of 12 months, Jane was able to buy that car, that same $20,000 new car that she was planning to buy, but her interest rate went from 14.719%, it went down to 4.929%. So her interest rate, her annual percentage rate went down by 10%. Her payment went from 470 something to $377 a month, which she could afford. Wait, what was her payment? Whoops. What was her payment before? It was going to be $473 a month. So it went down by almost $100. It went down by $96 a month. She could definitely afford that. And over the course of the loan, she saved $5,000. That was a much better loan for her. And what a big difference 12 months made. So I think the key for understanding credit is that we really need to make sure that when we apply for new credit, our credit report is in the best possible shape it can be in, and that we compare apples to apples when we're applying for a loan. So I go back to that chart where we're to that annual percentage rate. We want to make sure that we are comparing both the interest rate that's quoted and the annual percentage rate as it's calculated. And when you're looking at two different options or three different options, make sure that the fees that are included in the APR all match up. So make sure that you're comparing two different products that have the same information so that you can make the best educated decision that you can for what's right for you. So let's go back and talk about how we can get the best rates, because being able to compare those things is important. But the bottom line is we want to be able to get the best rates that we can. So, what are some things that we can do? Well, remember, I talked about in the very beginning of this, we want to make sure that the information on our credit report is accurate. It's amazing to me the percentage, the number of people who have information on their credit reports that's not accurate. The last time I pulled my credit, I found an address and telephone number that didn't belong to me. Now, that didn't impact my score, but it is important to make sure that that information is correct. And it's something like 10% of us who have mistakes on our credit report have a mistake that actually brings our score down. So that's why it's important to make sure that it's accurate. I think in Jane's scenario, she had information on her credit report that brought her score down. So by correcting that, it helped to boost her credit score. We also want to make sure that we pay all of our bills on time, every time. Even letting one bill go into delinquency by 30 days or more can have a negative impact on our credit report. Remember, we talked about what the different percentages were when we were looking at our credit score and our report. So make sure that we pay those things on time every time. And if you can, consolidating debt can be very helpful in lowering that percentage of utilization that you're using on your credit reports, and can help to pay off some outstanding debt, bringing it all together into one. So that can be very helpful. Use less than 30% of your total credit card limit that's available to you. That goes into your amounts that are owed. Owing less on credit cards will help to boost that amounts owed. It also will help with the credit mix. Limit the number of hard inquiries. A hard inquiry is when you're applying for a loan. So let's say Jane had applied for the car loan and decided not to take that first offer that she had, but 2 months later, she decided to apply again. Well, having two hard hits or hard inquiries on your credit score, on your credit report, can bring that score down. But Jane was smart and she waited the full 12 months so that it wouldn't have such a negative impact. And she got her score up, which enabled her to get the better rate. And the other thing that we can do to make sure that we get the best rates possible is to make sure that we keep those old accounts, those old credit card accounts. The amount of the credit history that you have, the length of credit is 15% of your score. If you close accounts that you've had for 20, 25 years, you're ending a long history. And that length of credit history is, the third most important piece that we need to consider. So make sure that you don't close out those old accounts. Make sure that you keep them open. So let's, as we're starting to wrap up, again, I want to make sure that I provide you with those resources. You can always check out our website, dobs.pa.gov. Our website has many, many publications on different topics, everything from borrowing carefully to avoiding predatory loans to saving and investing and consumer protection information. You can check your credit report at annualcreditreport.com. That's the only place mandated by the federal government to provide you with your free credit report. Now, I will say that there are many banks or credit unions, financial institutions, and credit card companies that will provide you with your score, your credit score on your monthly statements. So checking your credit report is important, but monitoring that score as provided by your financial institution or your credit card company can also really help, because if you suddenly see an increase or a decrease that you weren't anticipating, that can tell you that there may be a problem with your credit. So that's sort of a good red flag to keep in mind. Now, the Federal Department of Treasury has a Financial Literacy and Education Commission that has a website called mymoney.gov, which is a great way for us to learn more about how to manage credit as well as other financial information. So it's a great resource. And then the Consumer Financial Protection Bureau is another federal regulator at consumerfinance.gov that can help us with resolving any problems that we may have with financial institutions and other types of lenders, as well as providing educational materials for consumers. So make sure that you check that out as well. My Office of Consumer Services the Department of Banking and Securities has an Office of Consumer Services where our staff are happy to help you answer any of the questions that you may have. They may be able to provide you with more resources, as well as helping you to resolve any formal complaints that you may have against one of our regulated entities. So they're a really great resource as well. That does conclude our formal presentation. I want to thank you so much for your time and participation in this week's Midweek Money Matters. I am going to stop the recording now. If anyone has any questions, you are free to